In this video, we break down the psychology of scarcity and how it silently shapes your investment decisions without you even realizing it. In 2008, people lined up outside banks. In 2020, people lined up to buy stocks. Different crises, same psychology, scarcity. When something feels like it's disappearing, money, opportunity, time, the human brain shifts into survival mode. And survival mode is terrible at investing. We like to think our financial decisions are rational, based on data, valuations, fundamentals. But under pressure, the brain doesn't calculate, reacts. And scarcity is the trigger. Right now, markets move faster than ever. News spreads instantly. Prices swing in minutes. Every headline feels urgent. Last chance, limited supply, don't miss out. It doesn't matter whether it's housing, tech stocks, crypto, or AI startups. The pattern is the same. The perception of scarcity changes behavior. Once you see it, you can't unsee it. Here's how it works. Step 1. Attention narrows. Psychologists call it tunneling. When resources feel tight, money, time, opportunity, your mind focuses obsessively on what seems scarce. Everything else fades into the background. In investing, that means you stop asking broad questions like, what is this asset really worth? What are the long-term risks? How does this fit into my portfolio? Instead, you ask one question. How do I get in before it's too late? Scarcity compresses time, makes the future feel urgent, immediate, closing in. Step 2. Prices rising become proof. When an asset climbs quickly, your brain interprets that as confirmation of scarcity. If the price is going up, there must not be enough supply. Other people must know something. This is where fear of missing out kicks in. In 2021, meme stocks exploded in days. In hot housing markets, buyers waived inspections and overbid by hundreds of thousands. During crypto bull runs, coins with no revenue reached multi-billion-dollar valuations. In each case, scarcity wasn't always real, it was perceived. Perception is enough. Step 3. Risk tolerance quietly increases. Under normal conditions, you might hesitate to invest in something volatile or overvalued. Under scarcity, hesitation feels dangerous. If everyone else is moving and you're not, the brain interprets that as loss, even if you haven't actually lost anything. Behavioral economists call this loss aversion. The pain of missing out can feel stronger than the fear of losing money. So people stretch. They use leverage. They dip into emergency savings. They chase momentum. Not because the math improved, because the feeling intensified. Now here's the uncomfortable part. Scarcity doesn't just distort individuals, it shapes entire markets. When central banks flood economies with liquidity, capital becomes abundant. But safe, high-return assets remain limited, so money crowds into fewer opportunities. Prices rise. Valuations stretch. Scarcity shifts from money to yield. When interest rates spike, borrowing becomes expensive. Liquidity dries up. Suddenly, opportunities feel rare again, but in the opposite direction. Buyers disappear. Sellers rush for the exit. The scarcity shifts from opportunity to cash. Same psychology, different direction. And the math underneath doesn't care about your emotions. Let's say an asset's fair long-term growth rate is 7% per year. But during a hype cycle, demand pushes it up 40% in a few months. That 40% doesn't come from productivity or cash flow. It comes from future returns being pulled forward. You're borrowing from tomorrow? When scarcity drives price far above intrinsic value, future gains shrink. Sometimes they reverse. That's why bubbles don't just pop randomly, exhaust themselves. The pool of new buyers runs out. The perceived scarcity fades. Attention widens again. And when attention widens, reality re-enters the frame. What's fascinating is that scarcity works even when we know it's happening. Limited time offers increased sales, countdown timers, boost conversions. Only 2 units left changes behavior, even if we suspect it's marketing. Our brains evolved to survive in environments where resources were physically limited. Food, shelter, safety, in modern markets. Scarcity is often informational, social, narrative-driven. There is no fixed number of investment opportunities in the world. But there is a limited number of stories people can focus on at once. And when everyone focuses on the same story, it feels rare. Consider housing. When mortgage rates drop, monthly payments shrink. Buyers rush in, listings feel scarce, prices climb, news coverage intensifies. More buyers panic. But the number of physical houses didn't change overnight. Expectations did. Or think about initial public offerings during boom periods. Companies rush to go public when investor appetite is high. Investors scramble to get allocations because supply appears limited. Ironically, the moment everyone believes something is scarce, supply often increases. More coins get launched, more companies go public, more funds get created. Scarcity attracts production, and by the time new supply arrives, demand has often cooled. This is where disciplined investors separate themselves. They recognize that scarcity of attention is not the same as scarcity of value. They zoom out. They ask slower questions. What cash flows support this price? What assumptions are baked in? If growth normalizes, what happens? That doesn't mean avoiding every fast-moving trend. It means distinguishing structural scarcity from emotional scarcity. True scarcity might come from durable competitive advantages. Limited land in prime cities, network effects that are hard to replicate, regulatory barriers. Emotional scarcity comes from headlines, timelines, and group behavior. One creates long-term pricing power, the other creates volatility. And here's the paradox. The investors who feel the least urgency often perform the best. Because patience is the antidote to artificial scarcity. When you don't feel forced to act, you can wait for price to meet value. You can hold cash without anxiety. You can ignore noise without feeling left behind. But that requires something rare in markets: emotional slack, the ability to tolerate watching others win temporarily, the discipline to miss a rally, the humility to accept that you won't capture every opportunity. Scarcity tells you the door is closing. Experience tells you another door usually opens. The question isn't whether scarcity will shape markets. It always does. The real question is this: when the next wave of urgency hits, when prices spike, headlines scream, and everyone around you moves, will you recognize the feeling for what it is? Or will scarcity make the decision for you?